The most important, the most reliable way to measure housing prices in this country is year over year. And housing prices, let me just make this clear, are up year over year. If you think about like a tug of war, all of those things, all of the variables were on one side. They were all pulling prices up and up and up. There was basically nothing counteracting prices going up over the last couple of years. As we enter the middle of 2023 and the second half of the year, we'll probably have a better idea of what's happening with inflation, if we're in a recession and how bad it will be, and that's gonna give us much more clarity about mortgage rates. This is, to me, the X factor. It's finally over. The crazy, wild, confusing, unpredictable, whatever you want to call it, 2022 housing market is finally done. And now we can take some time to reflect on what actually happened. Of course, analysts and nerds like me are going to be analyzing what happened in the 2022 housing market for years to come. As we head into 2023, it can be really helpful to review what happened over the last couple of months to understand where we are today, because that informs what might happen in 2023 and can help us make strong, informed financial decisions. Hey, what's going on, everyone? My name's Dave Meyer. I'm the Vice President of Data and Analytics at BiggerPockets, and I am also the host of BiggerPockets' newest podcast, On the Market. So if you like this type of content where we talk about the newest data and news surrounding real estate investing and the housing market, make sure to check out On the Market. It comes out every Monday and every Friday. You can check it out on our YouTube channel or on Apple or Spotify. Also, if you like this video, please give us a like. We always appreciate that. All right, let's talk about what happened in 2022. We love talking about it like 2022 was just one thing, but in reality, 2022 was really a tale of two different halves. What happened in the first half of the year was very, very different from what happened in the second half of the year. In the first half of the year, basically what happened was a continuation of what was going on in 2021, which was just wild appreciation, right? We were still seeing double-digit year-over-year gains, sometimes over 20% year-over gains in certain markets, and that is pretty unusual, but it was basically a continuation of what had happened the previous year. Why this happened is because every variable that dictates what happens in the housing market was basically putting upward pressure on prices and sales volume. There are a lot of different variables that impact housing prices, stuff like inventory, demographics, mortgage rates, housing supply, all those different things. If you think about like a tug of war, all of those things, all of the variables were on one side. They were all pulling prices up and up and up. There was basically nothing counteracting prices going up over the last couple of years. That is until March of 2022, when of course we all know that the Fed started raising their federal funds rate. That is the interest rate that they actually control. It's kind of nerdy and wonky, but it's basically the interest rate at which banks lend to each other. They started to do that in March, and it didn't really happen all of a sudden. Like, we didn't see demand pull out of the market immediately because there was basically a lot of FOMO, right? Like, all these buyers who saw the writing on the wall and that interest rates were going to go up and the cost of debt was going to become more expensive. They were like, I want to get into the housing market, right? So in March, April, May, people were going crazy and just trying to buy before the full and actual real impact of rising interest rates was felt. We saw that even though rates started to go up in March, that the continuation of this 2021 market actually lasted till somewhere around May or June. We don't really know the exact date, but it was about May or June. Then starting in June and July, as mortgage rates kept going up and up and up, you started to see the impact that the Fed wanted, which was that people started pulling out of the housing market. The demand just got sucked out of it because affordability was too low, right? When prices are super high in houses like they were, people can still afford it sometimes if mortgage rates are really low, right? It's like 80% of people use a mortgage to buy their house. So if mortgage rates are super low, even though prices went up a lot over 2020 and 2021, it was still relatively affordable. Then when mortgage rates started to go up and housing prices were still really high, people were like, this is too much. It is too expensive. I cannot afford this. Inflation is eating away at my spending power. I'm out. And demand really started to fall. And when you look at the graphs of 2020, you can see that there's kind of like this pretty clear delineation of when demand was still going up and the impact of higher rates wasn't yet felt, and then what happened after. So let's just take a look at a couple of these charts. So the first one I'm going to show you is the median sales price in the US. And so you could see that over the last couple of years, it has been trending upward. That's generally what happens in the United States. But you can see a couple of things here. First, notice the seasonality. So if you look back at the years between 2016 and 2020, you see this pattern where it spikes and it goes down. And if you examine that closely, you can see that the pattern is the same every single year, right? It goes up, it peaks around June, and then it falls up until about January or February of the next year, then it goes up again, and that's just called seasonality. And it mostly happens because people want to buy and move and sell their houses in the summer. They don't want to do that in the winter, so demand goes down, and so prices fall. When we look at this year, you can see that prices actually peaked in May of 2022 and have been coming down. Now, we should expect them to come down from May or June, right? Because of the seasonality I just described. But when you analyze the data, you can see that normally in a normal year, prices from the peak in June to the decline in February or January of the next year is usually like 5-6%. This year, it's 9%. And that might not sound like a big difference, but it is a considerable difference. So we have reached a point where the housing market is definitely in a correction, and we were seeing housing prices drop on a monthly basis more than we would normally expect in a healthy market. Now, prices are still up year over year. So when we compare November or December of 2022 to 2021, they're still higher. And that is very important because it shows us that prices are not actually in a free fall. They are coming down. We are in a correction, but they are not in a free fall. The most important, the most reliable way to measure housing prices in this country is year over year. And housing prices, let me just make this clear, are up year over year. Now, I expect that to change next year, but as of right now, that is where we are. Next, the second thing I want to show you is look at this chart that shows months of supply. This is basically a measurement of inventory. It measures how many homes are on the market at any given time. And it's a great, well, not how many homes are at a given time. It measures how quickly homes are basically coming off the market. And so it's an excellent measure of supply and demand. And as you can see, months of supply was super low during the pandemic. From 2020 to the middle of 2021, you could see that it was about 1.5 months of supply. And then we hit this half, right? Remember, it's a tale of two halves. We hit the second half of 2020 and things started to skyrocket. And we are now basically starting to approach where we were pre-pandemic. So these are more normal levels of inventory that we're seeing. Personally, there's some data that shows that this is starting to level off, but there is some concern that this could keep going up, and that would put more downward pressure on housing prices. Last chart, I just want to show you about what happened in 2022 before we move on to what's going to happen next year. Home sales volume, and this is super important. Like the total number of sales was declining. And when home sales come down, that means demand is being pulled out of the market and prices tend to come down. And so you can see here on this chart that in 2021, we had really high home sales volume. And that makes sense because mortgage rates were low. People were eager to take advantage of that. 2022, things started well, and then they just fell off when mortgage rates came down. So you could see this clear division in 2022. And since the middle of 2022, as I've been saying for a while, we're in a correction. And I know people want to argue with me and say that we're in a crash. I personally don't think that's true right now because, as I said, prices are still up year over year. They're coming down monthly. And so there is probably going to be a decline next year. But I'm personally not of the opinion, at least right now, that we are going to see huge double-digit declines, at least in 2023. So now let's look at what happens next. And we're specifically talking about 2023, not all time. I know some people want to forecast it out 5 years from now, 10 years from now. What I'm talking about here is what's going on next year. And what I think is going to happen is that it is, again, likely to be a tale of two halves. Remember, we want to talk about 2023 like it's one thing, but it's not. And I actually think what we're going to see is in the first half of 2023, the most likely scenario is that we're going to remain in this correction. Things are probably not going to change. I think, in fact, in the first quarter of 2023, or maybe, probably around March or April, we'll start to see that very important year over year price number that I was just talking about switch to negative. I think we're going to start to see declines on a national level. I think sales volume is going to stay really low. And this is just because there's just too much uncertainty in the economy right now. Inflation has been improving, but it's It's still above 7%, at least as of when I'm recording this, which is far too high. We also don't know if and when there's going to be a recession and how deep that's going to be. Is unemployment going to get worse? There's so many questions that none of us know the answer to. And that is why I think we're going to see a lot of volatility. The housing market is just not going to be able to find stable footing during that time. It's just going to be a little bit volatile, at least through the first half of next year. By the middle of 2023, 6 months from now, economic conditions may not improve. I don't know. Like I said, there could be a recession, there could be job losses. We don't know. But I do think that the economic situation will be more clear. It might not get better, but at least we'll kind of know what's going on. And I think that's really important for the housing market, because the housing market, to me, next year is going to hinge, the second half of next year, is going to hinge almost entirely on affordability. So there are different scenarios based on the economic picture, and some of them point to affordability in the housing market getting better, and some of them point to it getting worse. And which way affordability goes is which way the housing market is going to go. So let me just explain that for a second. Housing affordability is not just prices. It's a function of three things. It's a function of wages, like how much money people make. It's a function of housing prices, of course. And it's a function of mortgage rates, right? We just talked about this. So right now, it's just too expensive. People don't want to buy houses. Sellers don't want to sell. We're at this stalemate. But if affordability improves, prices could start recovering, or at least flatten out. So let's look at those three things and see if any of these things are going to happen. First, we talked about affordability, wages. So if you look at this chart, you could see a disturbing trend here, that real wages, and when I say real, that just basically means inflation adjusted. Real wages have gone down from November of 2021 to November of 2022. And that's not because wages nominally, like the number on your paycheck, is going down. They're actually going up. But inflation is so high right now that it is eating away at your paycheck. And so real wages are actually going down. Now, there's a bit of good news here. If you look at the chart, you can see from September, October, November, real wages have actually been going up a little bit, but they're still below last year. And given where we are with the economy, the fact that we are very likely going to see a recession next year, and there's more, rumblings about unemployment, I think it's very unlikely that we see real wages go up, at least in any meaningful way. They could go up a little bit, but I don't think it's really going to make an impact on housing affordability in any way. So if we look at wages, I don't think it's going to help affordability. Housing prices. Now, housing prices, I do think, as I've said, are going to come down on a national basis. And again, let me just stress that I'm saying on a national basis. Certain markets will probably see the housing market keep going up, but on a national aggregated basis, I do think housing prices are going to come down modestly in the first half of next year. Again, I'm not saying there's a crash. I personally don't think that's the most likely scenario. Of course, it could happen. I don't think it's the most likely scenario. I think the more likely scenario is that we see single-digit drops in the first half of next year. Think somewhere between 3 and 5%. I don't know. I actually said 3 to 8% for all of 2023, but if we're just talking about the first half of the year, I think it'll be 3 or 5%, something like that. If we see that actually happen, that could improve affordability, right? Like on a $400,000 house, if prices go down 5%, that's $20,000 less. That's significant in terms of affordability. But ultimately, the way affordability really improves is if mortgage rates go down, right? That's what we have to see to really see better affordability. Now, there are a couple different things that can happen with mortgage rates next year. It is not cut and dry. And I know because the Fed is raising interest rate, it seems like mortgage rates are going to go up, but that is not necessarily true. There are actually two different paths that they can go. Rates actually go down. And there are two reasons this can happen. One, the first scenario could be that inflation continues to improve. It's been on a downward trajectory for 5 months. It's still super high, but if it continues on this trajectory, we could be in a place where inflation is at an acceptable level by the middle or later in 2023. If that happens, the Fed could pause their interest rate hikes or even reverse them, and that could help bring down mortgage rates. So that's one scenario. The second scenario is that there is a recession, and this is a very likely scenario, is that there is a global recession. What happens during global recessions is that investors from across the world tend to want to put their money in a safe investment. And the safest investment in the world is US government treasuries. They've always been paid. And so the demand for US government treasuries goes up. And when demand goes up, the government doesn't have to pay as much to these investors because so many people want them. And that means the yields come down. Bond yields, which is what I'm talking about, and mortgage rates are extremely closely correlated. They're almost 1-to-1. And so when you see these bond yields come down because of a recession, that should, as it pretty much always does, bring down mortgage rates. So those are two reasons why mortgage rates could fall in 2023, lower inflation and a recession. We could actually see both of those things, right? I can very easily envision a scenario where inflation goes down next year and we have a recession, which could both put down mortgage rates. Of course, there is a strong case for higher mortgage rates as well, which is basically persistent inflation. If inflation stays stubbornly high, the Fed is going to keep raising interest rates. That's going to put upward pressure on bond yields, and that's going to keep mortgage rates moving up throughout 2023. So as you can see, there's two different scenarios. Both are feasible at this point. If I had to guess and give you my opinion, I would say that for the first half of 2023, mortgage rates are going to stay very volatile. They're going to go up and down, probably fluctuate somewhere between 6 and 7% for the next several months. But as we enter the middle of 2023 and the second half of the year, we'll probably have a better idea of what's happening with inflation, if we're in a recession and how bad it will be, and that's going to give us much more clarity about mortgage rates. And so this is, to me, the X factor, because if mortgage rates go down, we're probably going to see the housing market bottom in late 2023, and we'll probably get away with single-digit declines in housing prices on a national level. Again, I've said 3 to 8%, and I personally, this is just my opinion, believe that this is the most probable scenario. Now, if the other scenario plays out where we see persistently high inflation and mortgage rates continue to go up throughout 2023, I think that we're in for a protracted correction, which is probably going to last more like 18 to 24 months. And we probably won't see the housing market bottom until the end of 2024 or even the beginning of 2025. And in that scenario, it is much more likely that housing prices go down somewhere between 10 and maybe even 20% on a national level. So to me, those are the two scenarios. If based on the data that I'm seeing right now and the trends that are occurring, I think the case where mortgage rates go down and end next year somewhere between 5.5% to 6.5% is the more likely scenario, which means that we'll probably see the housing market bottom somewhere about a year from now, late 2023, early 2024. So that is my best analysis of what's going on today. But of course, I will keep updating you. Data always changes, economic conditions change, and as those changes occur, I will continue to update my analysis and provide that for you here every single week. Thank you guys so much for watching. If you have any questions or feedback for me about this video, please hit me up on Instagram where I'm at The Data Deli. Thanks again for watching. I'll see you next week.